Well, thank you for joining us for today's webinar, What's Next on Your Financial Checklist? I'm Greg Berry, Assistant Director in the UAB Office of Alumni Affairs. Just a quick note, since we are coming to you virtually, don't be surprised if something is out of place or any technical issues may pop up. If you do experience audio or video issues, click the reconnect button at the top of your screen. This will get you back to the webinar right away. Today, we are taking a look at how retirement options like IRAs and other tax-deferred plans can help us meet our goals. So before we introduce today's guest, though, I'd like to ask a question. Where are you on your financial checklist? So the answers that you can submit are you just beginning? Maybe you're happy where you're at, but you're looking to see what else you should be doing, or perhaps you're confident that you've completed your checklist. We're going to keep the poll up just for a few more moments so you can submit your answers. At the end of today's presentation, we will have time to get to your answers. So drop those in the chat box. We will try to get as many of those answered as we can. So here is where we are at with today's poll. It's heavy right in the middle. You're just looking at what else you can do. Few of you say you're just starting out, and nobody, not surprisingly, said that their plan is complete. Thank you so much for taking part in our poll today. So today we are joined by Elizabeth Turnbull. Elizabeth is a fellow with Regions for Financial Education. There she gives seminars on financial literacy. She is also a member of the faculty in the UAB Class School of Business, where she teaches introductory classes. She earned her bachelor's degree from Auburn University and her MBA from the University of South Alabama. So at this time, I would like to welcome Elizabeth officially. Elizabeth, we're in your hands.
Thank you so much, and thank y'all for being here today. I also need to add that I recently completed another master's program here at UAB, so I am a fellow Blazer, and I'm really excited to be part of officially, not just as a faculty member or as a staff member, but also as an alum as well. So go Blazers. So I'm really excited to talk to y'all a little bit about what we can be doing next on our financial checklist. So I understand that just based on that poll, we're kind of a little bit all over the place, which is great because some of us are more just have worked through more steps in our financial journey than others. So you are not going to be feel out of place if you haven't gone very far in your journey. And hopefully, if you have made a lot of steps to become a little bit more financially healthy, as we'll say, that you'll feel more sure in your choices. So today we're going to go over some different retirement accounts, some things just to kind of make sure that y'all are just where you want to be. So look at some different accounts that you could be pursuing in the next couple of months, or maybe you could be increasing your contribution to in the next couple of months. But all in all, let's look at some ins and outs of different retirement accounts and what is out there for us. So you will notice as I go through this PowerPoint that, not necessarily this slide, but the ones coming up, that there are a lot of words on these PowerPoints. Normally, I wouldn't crowd the slides so much, but because we're in our virtual world where we know anything and everything can happen with me freezing or your screen freezing or audio not coming through, I wanted to make sure that you could at least see all the things that we're talking about. So you'll notice some more information on these PowerPoint slides, some just more information about the talking points that we'll go through. So today, I'm going to talk about 401ks, what they are and how they work, so how they'll benefit you. You'll also notice that in some, or from some employers, they might be called 403Bs or 457s. And so really, a 401k is usually from a public company or corporation, and then 403s and 457s are from government or nonprofit organizations. So they work the exact same way, but you will find if you work for one of those different types of entities, they're just called something different, and that's just for IRS purposes. After that, we are going to talk about the two different IRAs. So individual retirement accounts will go through traditional and Roth. And then hopefully we will be able to hit a new thing on the block called Roth 401k. So there's a few employers out there that are starting to offer and have been offering a Roth 401k, but it is not as widespread And so I wanted to make sure that you're aware of it, what it is and what it isn't. And especially if you all are on the job hunt, that you could be looking at not just salary, but also those benefits and how it could benefit you. Because obviously some retirement accounts and different retirement vehicles in general are more beneficial to you depending on your life stage and then what's going on in your life. Do you have lots of kids or dependents, or do you not? Like, what are your retirement goals? Are you wanting to have, houses all over the world, or are you wanting to live off the grid? I don't know. Whatever your goals are, we want to make sure that you're aware of what those accounts are and what would be best for you. So also let me say that, yes, I'm a faculty member over in the School of Business in our beautiful building that's only a couple years old. Y'all should come over and visit if you ever get a chance. But also, I am not a certified financial planner. So please know the things that we talk about today, while I can give out some advice to you in general, general numbers and general information, that you specifically need to talk to someone that knows a little bit more about your specific situation and how, so that they can direct you on what would be the best thing for you. So I just want to kind of throw out that disclaimer. Okay, so 401ks. So these have been around for a while. The reason that we need to be so intentional about our retirement is because things aren't like they used to be. So our grandparents, they would go to work for a company for 25 years, they'd get their pension, and then they retired and just lived their life with their pension, their income every month. That was definitely there. And that's just not really a thing anymore. Unless you work for the state or federal government, you're not really getting a pension. And so that means that we as Americans need to be more concerned and more financially literate. We need to take these things into our own hands and make sure that we're taking care of ourselves, because we know that no one in the world, we don't live in a world where somebody's going to come up to us and say, I'm really concerned about you and your retirement plan. And so we know we have to kind of take the bull by the horn, so to speak, and make sure that we are caring for ourselves. So 401ks are kind of a way that employers have chosen to help us save for retirement. So there's a lot of benefits to 401ks, but there's things that we need to know about. So the first thing you need to do is go to your employer and see what is it that they offer in terms of retirement. Some will offer more than others. But if they do offer a 401k plan, you need to look for that word match. So different employers will match your contributions more than others, and they'll do it at different percentage rates. And so most of them are under 10%, most under 5% of a match. But again, different employers offer different amounts. And again, the reason that matters so much is that some employers might choose to pay you well, but then their benefits aren't so great. And so that might be beneficial for you. I don't know. But then there's other employers whose salary offerings might not be as high as others, but their retirement plans and other benefits are really great. So you need to sit down with other people that you know, love, and trust. Also go consult certified financial planners and other people that banks, brokerages, and whatnot, and see what would be a better option for you. But regardless, you need to know what employers offer. So let's dive into this 401k plan. So a 401k plan is sponsored by your employer. So that means if you are unemployed, there's no way to get a 401k plan. They are offered through your employer only. And so when you decide on while you're employed, they will ask you if you want to contribute. That's the word they will use, contribute to your 401k. And so you will get to answer yes or no. So these things are not mandatory. They are optional for you, and you can choose to be a part of it. My opinion, but again, go get opinions of other people you know, love, and trust. My opinion is you need to be enrolled in a 401k plan if possible. So 401k plans, again, are through your employer. And what will happen is you will contribute or you'll contribute money to your 401k plan through your a payroll deduction, so through your paycheck every week, 2 weeks, every month, however often you get paid. And that money will be diverted into an account that is invested in the stock market for you. And so they will be put into stocks and bonds and mutual funds, and it will be managed by a group, a financial institution for you. So luckily, that means that you do not have to be a market whiz in order to choose which stocks, bonds, mutual funds, etc., for your money to go into. So that will hopefully relieve some of you that you're not having to make all of those decisions, but at the same time, you do get to have a say. So you can meet with the people that are managing those accounts, and you can collectively decide what group of stocks, bonds, mutual funds, and whatnot that you would like to invest in. So there is a little bit of leeway, but it is taken care of and managed for you. So while you're employed at said employer, every paycheck you will be giving or contributing money to this 401k plan. So your account will grow as you contribute more and as the market does well. So if the stock market, if it does well, your 401k plan will grow, and in downturns, it will shrink. But before you get nervous about that, know that we all know that the stock market ebbs and flows, but we know over decades, which is ideally how long we're supposed to leave this money in our 401k, there has been, historically, there have been returns, positive returns in the stock market. So much higher returns than if we, well, one, just put the money in a mattress somewhere, under a mattress somewhere, or just in a savings account. So while the market is risky, long term, the risk is low. So all that to say, you can be monitoring your 401k and see how it grows, but don't get obsessed with it. That's not good for any of us. But anyway, so you're contributing to your 401k plan. Know that it is something called a pre-tax deduction. So what that means is that we are giving or contributing money to our 401k plan, and we are lowering the amount of money that the government sees that we're earning. So I'm going to show you an example in just a minute, but let's say that you had a $1,000 paycheck. Well, normally the government would come in and see that you made $1,000, and they would then take taxes out of that $1,000. So they're going to tax you on that full $1,000 amount. Well, if you choose to contribute to your 401k, you are going to lower your taxable income. So instead of being taxed on that full $1,000, let's say that you decided to contribute $50 out of your paycheck to your 401k. So now instead of the government seeing that you made a full $1,000, you contributing $50 has lowered your taxable income to $950. And now you're only being taxed on the $950. It's as if the government did not see that you made that full $1,000. So you're lowering your taxable income. And most of us do like to pay less in taxes. And realistically, the government has set these 401k plans up, or they've set up rules to incentivize us to save for our retirement. So they're saying, yes, we will pat you on the back or say, good job, gold star, we'll give you benefits if you decide to contribute to your 401k now. So you're putting money up for your retirement, you're being that responsible person, so we're going to reward you by allowing you to pay less in taxes now. So that's kind of one of the pros of a 401k plan. But we all know that this is, we all have to pay our fair share in taxes, and everything gets taxed at some point. So the kicker, I guess, about a 401k plan is that while we save in taxes now during your working years, during your 20s, 30s, 40s, 50s, and so on, that when you start withdrawing from that 401k plan, you will be taxed then. So when you start withdrawing at 59.5 is the minimum age that you can start withdrawing from your account without penalty. And why it's 59.5, I really have no idea, but 59.5 is that minimum age that we can start withdrawing from our retirement account. And again, once we start withdrawing, that's when the government comes in and says, you didn't pay taxes on it then, so you're going to pay taxes on it now. So you will pay taxes on whatever it is that you withdraw. So if you withdraw $10,000 in 1 year, you'll pay taxes on $10,000. If you withdrew $50,000, you'd pay taxes on that distribution, that full $50,000. So again, when we all get closer to retirement, you would need to talk to a retirement counselor as well to see how it would be best and most beneficial for you to take those distributions. But that's later. Right now, we're just trying to decide, is a 401k a good idea for you, and how you can put it into and implement it into your life at the moment. So other things you should be aware of. So these are the kind of questions that I usually get when I talk to my students about this. They say, what happens if you pass away before 59 and a half? What happens to your money? So the day that you sign up or decide to open up your 401k account, you will fill out a beneficiary form. So then you are naming whoever your beneficiary is. So your parents, your kids, your cousin, your friend, whoever you want to be your beneficiary. If something happens to you before 59 and a half, and the money will go to whoever you have designated it to go to. The other question I typically get about 401ks is, what happens if you decide to leave your current employer? So 401ks are fabulous in that they are called portable accounts. So this means if I work for one company for 5 years and I decide to go to another company, that I can go to company B, so that second company, the new company, and I can, via paperwork, fill out paperwork for my old company to send my old money to my new company's 401k. It's called rolling your 401k or the funds to your new account. So you can continue with this growth, and this account is following you from company to company. You don't have to move it. You can leave it at old company and it can grow. You just won't be adding to it, obviously, because you're not contributing any money to that old company because you don't work there anymore. But you have the option to carry this account around with you from company to company, which again is different from our grandparents who worked for a company for 25 years. If they quit in year 15, they kind of lost some pension money, right? So this is kind of a nice pro to 401k in that it is portable. So the last thing, again, on the 401ks on this slide that we need to make sure we are aware of is that at 59 and a half, we become eligible to start withdrawing. But let's say that you're still working and you don't want to withdraw. You don't have to. You can keep working and contributing to your 401k and letting it grow in the market and whatnot. But at 72, we have to start taking required minimum distributions, or RMDs. So at 72, if you have retired, you're no longer employed by that particular company, you have to start withdrawing. But if you're still working, so if you're 75 and you're still working, then you don't actually have to take those minimum distributions. So there's a little, there's some rules within that 401k that we need to be aware of. But 59 and a half is that magic number. So what happens if you want to withdraw your money before 59 and a half? Let's say something happens and you just want your money. You're 40 and you want your 401k money. You do have access to it. You can get it. However, if you withdraw early, which is anything considered before 59 and a half, then the government comes in and not only taxes you on that withdrawal, but they also then impose a 10% penalty against you because, again, this was a 401k plan. It was meant for retirement, and obviously you're using it before that, quote, retirement age. So just some things to think about as you are putting that money away. So some different things that we need to be aware of as well with that 401k is the contribution limits. So you can only contribute up to $19,500 to your 401k per year. So that just is kind of deterring you from, I guess, ideally 401ks are not necessarily meant for people that are incredibly wealthy. These things were designed for say lower income, but I don't necessarily, middle class as well, but just not ultra wealthy people. So trying to deter them from, contributing hundreds and hundreds of thousands of dollars that will be tax sheltered for decades. This is really meant for average people. And so they do put a limit on the amount that you can contribute per year. So then not only is there a limit on what you can contribute, but then also what you and your employer can put together, and you can see that limit on the screen as well. But again, the average person never gets to those limits. So, don't get too stressed out about that. If you do, that's great. If that's, your salary, you earn that kind of level of salary, that's great. But again, the average person. Okay, so let's look at this chart on the screen and see how this really looks when we look at actual dollars. And what does this mean? Are we really saving any money when we contribute to our 401k? Or you might be thinking, oh my gosh, I need every dime that I make, every single paycheck. How in the world could I implement a 401k into my routine? And so you can see what the difference between contributing versus not contributing really actually means. And on the left, in that kind of beigey color, contribute to our 401k, we see that pre-tax deduction. So you see that we made $1,000 and $50 came out. That was us contributing to our 401k, and it lowered the taxable amount to $950. And then when tax comes in, you can then see at the bottom your net weekly pay. Then on the right, in that kind of, I guess, orangey color, maybe I should have chosen some other colors that have definite names, but do not contribute to a 401k. You can see how there is no contribution. You're just getting taxed on a full $1,000, and how that means obviously you are paying a little bit more in tax, and what that looks like in your net weekly pay. So realistically, you can see that contributing $50 to your 401k only actually reduced your paycheck by $36. So while it does obviously take away from your net pay, it is not the full amount that you contributed, because again, you're paying less in taxes. So you can see how that might be advantageous for some of you. And then remember also, if your employer matches your contribution, then you're really increasing the amount that's going into your 401k at any given time. So typically, like in this situation, if your employer matched your contribution of 5%, then when you put $50 into your 401k, your employer would have put an extra $50. So that would have meant by you giving $50, you actually now have $100 in your 401k. So you can see how that match could really add up and really make a huge difference to you in your retirement funds. So please make sure you're paying attention to that word match when your employers are offering it. And if at all possible, at least contribute the amount that they're matching. So if they say they'll match up to 5%, do everything you can to contribute at least 5% of your paycheck. If they only match 2%, then at least give 2% of your paycheck. And I say that because that will be the most advantageous to you. Because if they say we'll give 5% and you only give 2%, then they're only going to meet you, right? They're only going to meet that 2%. They're not going to just give 5% to do it. You have to make that first move and say, I'm giving this much money, and then they come in and they'll match it as well. So again, make sure you're paying attention to that verbiage and on your HR site or wherever your benefits are listed. Okay, so now let's move into IRAs. So IRAs are a little bit different. They are not necessarily sponsored or given through your employer. Some employers will offer to help you set one up, but most employers don't go and offer IRAs, so individual retirement accounts. These are opened at brokerage houses. So these are your Charles Schwabs, your Edward Joneses of the world. or a bank. So you can go into Regions, Compass, Wells Fargo, wherever you bank, and you can open up a traditional IRA or any IRA. We're going to talk about Roth IRA in a minute as well. So you can do these at brokerage houses or banks. So if you choose to open up an account at a brokerage house, they will invest it in the market for you. So you will get to talk to them about where you would like to invest your money. If you want high risk, low risk, mid risk, I mean, they'll talk you through that. If you open up your account at a bank, they're going to put it in a savings account or a certificate of deposit so that your returns will be significantly lower. Because you know right now savings accounts are only paying less than 1% interest. So, you know, not great, but it is pretty low risk. So you have to decide where you would like your IRA to be opened. So know that since this isn't through your employer, this means it is attached to you. So it doesn't matter if you move jobs, it will still be, you won't have to do any paperwork if you move jobs, unlike the 401k where you have to fill out paperwork to roll it. But this one, it's just with you. So there is a limit on what you can do every year. A traditional IRA is a pre-tax deduction. So that means that you are lowering your taxable income every year when you contribute to a traditional IRA. So just like a 401k though, you are that pre-tax deduction. That means you aren't paying taxes on it now. So when you are older, retired, then you will pay taxes on it then. So you're saving yourself some money in the present tense because you are not paying taxes on it now, but you will pay taxes on it later. So every single year you can only contribute up to $6,000 into a traditional IRA. Those limits do change. The IRS, excuse me, they increase those limits from time to time, so you can contribute more. One of the great things about an IRA is that you can open one in your name. And let's say that you have a spouse that does not work. Let's say that they're a stay-at-home parent or they are self-employed, so they don't have the option to have a 401k. You can open up an IRA in their name, and you can put $6,000 under your name and $6,000 under their name. So you collectively then will be increasing your retirement funds as well. So that can be a great option for you. And those of you, if you are self-employed or you're between jobs, or you know, maybe your company doesn't offer a 401k, whatever it might be, IRAs are a great option for you because they are not, again, tied to your employer. The only other thing we need to make sure we understand about IRAs is, again, they are that pre-tax deduction, which means you're not paying taxes on it now. So that means if you choose to withdraw before 59 and a half, and again, why 59 and a half is that magic age? I don't know, but that's what we've decided right now. If you choose to withdraw early, is what we're going to call it, then you will pay a 10% penalty on that withdrawal. So just know that it's kind of locked in. So I've kind of given you some pros and cons about the traditional IRA. Just like a 401k, you have to start making or taking, distributions by 72. So minimum age of 59 and a half, maximum of 72 is when you actually have to start withdrawing from that IRA. So other things you might need to make sure you understand under the pros list that can be a major pro. So there are some exceptions as to when you can take money out, quote, early without a penalty. And that is for things like college expenses. So that can be nice for some of you who either you're thinking about going back to school or maybe you are paying for someone else's education. The money can be used for certain expenses and you won't be penalized early. You'll still have to pay taxes on the distribution, but you won't have an additional penalty for withdrawing early. And then there's a homeowner one as well. So you can see how there are some different rules on how you can get to your money early without paying a penalty. Okay, so next is a Roth IRA. So it is named after Congressman Roth. So a Roth IRA is a little bit different than the other two accounts that we have talked about. So here is my opinion. Again, go get the opinions of other people you know, love, and trust. I am a fan of a Roth IRA, and I'll tell you why. Again, it might not be the best move for every single person, and I'll tell you why in a minute, but I do really like a Roth IRA. This is opened up through a brokerage house, so your Charles Schwab's, your Edward Jones's, those types of places, and also through banks. So you can do either one, whatever institution you're most comfortable with or familiar with or just like. A Roth IRA has those same limitations on contribution limits as a traditional IRA. It is $6,000 a year that you can contribute to a Roth IRA, but a Roth IRA is an after-tax deduction. So the reason that I love a Roth IRA is that while you pay taxes on your contribution now, so meaning you're just giving to your Roth or contributing to your Roth IRA just out of your money, you're not getting any kind of tax advantage during your working years, your 20s, 30s, 40s, 50s, and so on. But once you contribute it to your Roth IRA, it grows through, 20s, 30s, 40s, and 50s, and so on. And then when you start withdrawing it at retirement, the government cannot touch a dime because you've already paid taxes on it. So they cannot tax the principal that you contributed, and they cannot tax the earnings. So it is your money. I'm just a fan of that for various and sundry of reasons, but the reason that not everyone does a Roth IRA is very practical. Some people say, you know what, I need that tax break now. I need to pay less in taxes now, and I'll worry about my tax burden later. And that's okay. There's nothing wrong with that. I mean, you're saving money now, and that's great. But if you can afford to forgo or to, if you can afford to pay that more or carry that tax burden now, it can be a very beneficial thing to have tax-free growth and never have to pay taxes on that later. Okay, so other things that are interesting about a Roth IRA. So again, that 59.5 is that magic number where you can start withdrawing. But let's say that you need to withdraw early. Let's say you're 35 and you really need your Roth IRA money funds for whatever reason it might be. You can withdraw the principal, so the amount that you contributed. You cannot withdraw the earnings early without penalty, but you can withdraw the principal amount with no penalty. So your account has to be open for 5 years, and then you can start withdrawing the principal without penalty before 59.5. I hope I said that clearly. So meaning before 59.5, you do, and you always have access to that principal amount. So that can be a really great thing for some of you, and you might use your Roth IRA as like your emergency account. So you know that you have access to it. It's really supposed to be for retirement, but if you needed the principal amount, you could get to it. So that's kind of a pro to the Roth IRA, and something that should make it more of an attractive retirement vehicle for some of you. There are no required minimum distributions ever, so that's kind of nice as well. And also beneficiary things. So if you were to pass away and you leave your Roth IRAs to your kids or uncle or whoever you're leaving it to, since the taxes have already been paid on the Roth IRA, they're not having to pay additional taxes on that, unlike a traditional or 401k. Because again, the money has to be taxed at some point. So there's some pros. Okay, I'm going to go through a Roth 401k really quickly because I want to make sure that we have time for questions. But a Roth 401k is kind of the mix of that Roth IRA and a 401k. So it's a little funky and a little bit different, and something that is newer to the retirement, account world. It hasn't been around as long, and so not as many employers offer it. But again, some of you might currently work for a place that does, and you need to know how it works. Or maybe some of you, again, are on that job hunt and looking for, how could this really benefit my life? Would this be a good thing? Would it not? Does it matter? And so on. So I'm going to kind of throw some slides up to show you some differences between a traditional 401k and a Roth 401k. So you can see some of those similarities. There are limits to how much money that you can put into or contribute, excuse me, to those accounts, but you can see how they're taxed differently. So when you start withdrawing, your distributions are taxed under a traditional 401k. and a Roth. They are free from federal taxes, again, because you're paying it at different times. So remember, in a traditional 401k, you're putting taxes off till later. So you're lowering your taxable income now, yay, paying less in taxes now, yay, but you're then putting off the taxes till you're older. He's old. Roth 401ks, though, you're paying all of the taxes on it now. So when you are older, no more taxes on it. So that can be something that is attractive to some of you. Okay. Other things that we need to make sure that we understand. So a traditional IRA, you have some distribution limits. So generally on all of these things, you're not supposed to be able to have access to the money before 59 and a half. There are, again, those other reasons that, something could happen that you could get that money early. So, and you can see them on the screen. So there's a little leadway. Obviously, if you pass away before 59 and a half, the money does become available to your heirs or your beneficiaries. If you are disabled before 59 and a half, there are reasons that you can, again, get access to your money without those penalties, but they're very few and far between as the reason that you can access the money before 59 and a half, but you can see them on the screen. Other things, they're minimum required distributions. So you have to start taking distributions at 72 under a traditional 401k, but a Roth IRA, if you leave it at, a Roth 401k, I said that incorrectly, I'm sorry. Under a Roth 401k, you are required to take distributions, but if you then take your Roth 401k and you roll it into a Roth IRA, then you can not have to take those required minimum distributions. So you don't have to start withdrawing at 72. You can leave it there forever if you want to. But again, that requires you rolling it into a different account. Again, if this is getting too much for some of you, like you're like, let me get the other stuff first. That's fine. You can look into these types of accounts or what you might want to do closer to retirement. You can talk to a counselor and you are fine. Okay. So we talked about the rollover options. So we'll keep moving. So the difference with a 401k and a Roth 401k is that employer matches, this is where it kind of comes into play. So under a traditional 401k, typically an employer will match your contributions, which is kind of nice. If you remember though, a Roth IRA has nothing to do with your employer, so there is no match. So that is done on your own. But with a Roth 401k, there is an ability for employers to match your contributions. So it's this magic world of the Roth IRA with those tax benefits and then that match. It can be a really great thing for some of you. Again, it's something to think about, and it's only offered through your employer. So you can't just go to a brokerage house and have a Roth 401k. That this is through your employer again. Okay. So let's look at a difference in the traditional 401k and a Roth 401k. So you can kind of see how all of this kind of plays out. So a Roth 401k, again, you have that after tax deduction. So you're paying taxes now and you're contributing to your Roth 401k, you're contributing to it after tax. So you already paid taxes on that money. Therefore, you don't have to pay taxes on it later. A traditional 401k, you're lowering your taxable income now and you're going to pay taxes on it later. So you can see again on this screen that net weekly pay, you can see the difference in your pay based on that before tax or after tax deduction. So you might be thinking also, I thought she said there was something about an employer match, and there can be. So I don't have it listed on this particular example just because for lack, I didn't want to get too crazy confusing. But if your employer chooses to match your contribution, this is where that 401k part comes in, it would be taken before tax or pre-tax deduction. So a Roth 401k has the option for a pre-tax and an after-tax deduction. So if your Roth 401k has a match associated with it, then that means the employer or you are choosing to contribute, and your employer's contribution is lowering your taxable income, and then your contribution is then comes after you have paid taxes on it. So again, it's kind of marrying this idea of the Roth IRA with your after-tax deduction with the 401k, which is a pre-tax. So you can kind of get benefits on both ends. You can have some lowering your taxable income now and then not having to pay taxes on your earnings or some of the earnings later. Okay, so what and how do you choose what to do? You know, you have all these accounts. Which one should you do? Because you should know that you're allowed to have multiple retirement accounts. If you have a 401k with your employer, you can choose to have IRAs as well, or in addition to. So ideally, it would be nice to have multiple retirement accounts. That's not a bad thing. And again, that depends on how you want to diversify. That's, you know, our big fancy business word, diversify your accounts. So do you want to have pre-tax deductions or after-tax deductions? Because that's really going to determine which accounts you choose to get. You might be thinking, should I have a traditional IRA and a Roth IRA? You can. It's kind of strange, I guess, because collectively you can only put up to $6,000 a year into an IRA. So if you wanted to have a traditional and a Roth, then you could put, you know, 4 in one and 2 in the other, or 3 in 3, whatever it is. But combined, you can only contribute up to $6,000 a year into an IRA. But again, you can have a 401k and a Roth IRA, or a 401k and a traditional IRA. You can have as many retirement accounts as you want, but don't think, oh, well, if I have 2 IRAs, then I can contribute $12,000. No, it's up to $6,000 per taxpayer. So know that, you know, just as you're sitting here thinking about how you can diversify, there are limitations within that. So how do you choose which one to do? Honestly, you need to sit down and figure out, what can you afford? If you can afford to have an after-tax deduction, then a Roth is a great idea for you. If you want to have tax-free growth and not have to pay taxes later, fabulous. But if you say, you know what, no, I'm working, I'm raising kids, I'm taking care of my parents, I mean, whatever, all of life's things that you have going on and you need every dime in your paycheck, then there's nothing wrong with having the traditional IRA, because you're still putting money away. You're still contributing to a retirement account, which is a good thing. So you're saving tax, you're lowering your tax burden now. So all of this also has to do with, where do you think taxes are going to go in the future? If you feel like taxes are going to be a lot lower when you retire, then that will determine, what you do and don't want to do with taxes now. Or if you feel like they're going to be higher later in retirement, then that will determine what you want to do now. So again, this is a very individual answer for you. I can't sit here and tell you should all do X or all do Y. It is really determined on who you are, what's going on in your life, what life stage you're in. I mean, if you're, closing in on retirement versus you're 25 and just kind of starting out, I mean, all of these things factor into your decisions. So with that being said, what questions do we have? Because I think we have about 15 more minutes for questions. So I'm sure y'all have them, and I will do my utmost to answer them.
Well, thank you so much so far for the information that you have passed along to us. So let's get right to the questions. And the first one is, so what's the difference between a Roth and a traditional savings account with a bank? Asking as they both seem to sometimes involve funds that have been taxed?
Yes. So the difference is, again, how they're phrased or how they're titled at your particular bank. So they will, have your name, the account, and it'll say Roth IRA or traditional IRA. And that will be used for your tax purposes. So if you have a Roth IRA, you will not be able to decrease or claim that on your current tax return. So it will just be like another expense that you had. As opposed to if your account is labeled a traditional IRA, then you can lower your taxable income. So you'll notice on your 1040 or whatever tax forms that you fill out, you will see a line that asks you if you were able to contribute to a tax deferred plan. And that's when you will be able to submit that paperwork and then lower your tax burden for your current year.
Can you talk anything about a TIAA?
TIA CREF, yes. So that I'm hoping hopefully I'm answering what you're asking. TIA CREF is a financial organization that handles a lot of retirement accounts. So like I work for UAB, and UAB has partnered with TIA CREF. And so when I contribute to my 401k, the money is then managed by TIA CREF. So UAB is not handling it. That financial institution is. So let's say, God forbid, something happens to UAB and they go bankrupt or whatever, not in existence anymore. I still have my account at TIA CREF because they're managing that money. So that's that idea that when you contribute to your 401k, 403b, whatever your retirement account is, it is being managed by an independent financial corporation. So that has been contracted through your employer to handle and manage that fund for you.
You just mentioned 403b. Can you elaborate a little bit more about that?
Yeah. So again, 403bs and 457s and 401ks, they're all the same thing. They all work the same way. It's just if you are employed by a government agency or a nonprofit, then they're, instead of being called 401ks, they're called 403bs or 457s. They work the same way. They're all under the retirement, listing under the IRS. They just code them differently. So it then tells the IRS that you work for a nonprofit or a government agency or a for-profit company. Mm-hmm.
So can you switch from a traditional to a Roth and vice versa? Can you go back and forth?
Yes and no. So if you have a traditional, you can roll it to a Roth. So what will happen is, again, you'll fill all of this out on paperwork. They will do it for you. They're not going to cut you a check or anything. Don't do that, because then the government sees that you got it before 59 and a half, and you get all kinds of penalties on that. So you're doing all of this with paperwork. But if you have a traditional IRA, you can roll it to a Roth IRA, and they will take the tax. You'll pay the tax burden the second that you roll it, but then it grows tax-free for the rest of however long you have it. But you cannot take a Roth and convert it to a traditional. And that wouldn't make sense anyway, because you've already paid taxes on a Roth. You wouldn't want to convert it to something that then you have to pay taxes on again. So you can roll traditional to a Roth, but not a Roth to a traditional.
Okay. So is there any such thing as a golden IRA?
I've never heard that term. Somebody might. I've never heard that term before. So
fair enough.
Yeah.
So the example you showed with the Roth having a lower payout. So is traditional really better than that then? Or it just depends on who you are and what you're trying to accomplish?
It depends on who you are and what you're trying to accomplish. So is it better in the short run? No, because you're paying that full tax burden. But in the long run, I mean, if you're a person that in your 70s, 80s, or whatever your golden years, you don't want to have to deal with the tax burden of whatever it might be. Because, none of us have a crystal ball. We don't know what tax rates are going to be in the future. We don't know how things are going to be taxed in the future. If you're saying, I don't want to deal with that, then you pay the taxes now, and then you have tax-free growth, and you don't have to deal with that when you're older.
Have you ever heard anybody using cash value life insurance similar to a Roth if they don't qualify for a Roth?
I have heard of that. I can't speak intelligently necessarily on that, because again, it would really, depend on your very specific situation and what you're trying to accomplish. Yeah.
And I think you may have answered this.
I'm not trying to punt. I don't know. Yeah.
No, completely understand. I think you might have addressed this, but just to go back to it, can you have both a traditional and a Roth account, or just one?
You can have multiple, but you can only contribute up to $6,000 in them. So if you have two, then $6,000 combined between the two.
So 3 in one, 3 in another.
Yes. And again, I looked up Golden IRA. I'd have to read more about it. Y'all have taught me something new. I was not aware of this, but apparently it is one that will hold precious metals, so literal gold. I'll need to read about that. I don't
Well,
to me, it's another investment, just like anything else. But anyway, sorry.
So the per year amount, which is this, 6,900, I think is what you said. Is that a per year max combined match and personal contribution, or is that you can have 6,000 and 6,000?
No. So under the 401k, there are income limits, or the amount that you can contribute. They also have those under your IRAs. So depending if you file as single or married, or all of your filings, there's some differences as well, as because again, these accounts are really meant for the average person. The government is not trying to create accounts that millionaires can just sock away tax sheltered money, for retirement or for other purposes. This was really designed for people that are average, and making average salaries and don't just have assets laying around, and what have you. And so they do have income limits, as meaning if you make more than X amount of money, they say you can't contribute anymore because of that idea. Like if you're attained a certain salary or level of income, you have other options available to you. This is really, we're trying to tax shelter for people that are have average types of salaries. And again, you can Google that and see based on your, if you're single, married, filing jointly, married, filing separately, head of household, all of the things that make you different, you can look up what those limits are. But no, for IRAs, it is $6,000. They do, again, every couple of years, they increase it. So it used to be 4,000, and then after, it went to 4,500, then 5,000. I mean, they do adjust it as time goes on. But at the moment, in 2021, you can only contribute $6,000 a year to an IRA.
Do you keep contributing to a Roth IRA, or is it a one-time contribution? This person asks because they mentioned being able to withdraw the principal.
Yeah, so you can contribute every year that you have it. You don't have to, because again, it's not through your employer. It is just you of your own volition. So if you want to contribute $6,000 this year and $1,000 next year, it's up to you. I mean, some people write one big check at the end of the year. Some people have it, like a more automated. So $200 is coming out every single month, or whatever it might be. Mm-hmm.
So we have a 59-year-old who's planning on retiring. Is it too late to start investigating in a retirement account?
No, thank you. I'm so glad that came up. This is something that it doesn't matter what age you are. Take advantage of these tax shelters, man. I mean, all the tax benefits, whatever, if you get it for a year, or the benefits for 60 years, who cares? Y'all know that as Americans, or as people, we are living longer. So 59 and a half isn't what our grandparents experienced at 59 and a half. So that is still very young. I mean, life expectancy is well into the upper 80s, and men are catching up with women. I read that the other day. Men are living longer as well. So we're having to plan for 30 years of retirement. So if you're 59 and a half, make sure or 59, excuse me, that's what you said. Start investing. I mean, you don't have to withdraw at 59 and a half. That's just when you become eligible. So if you're still working, or still have money to contribute, or the ability to contribute, for sure, get you an IRA, keep contributing to it. A Roth IRA, you never have to take a distribution, so you can contribute, in forever. And then a traditional, you still have 13 more years to contribute before you have to start withdrawing at 72. So yes, for sure, it is not too late. The sooner the better. Do not delay. Run to that brokerage and set up an account. Mm-hmm.
Do you know if UAB will allow employees to make additional contributions to their 403B?
Yes. So UAB specifically, they do a 5% match. So you can contribute 10% and just get a 5% match. So you can contribute extra amounts. You just go through, there's a website through your portal and you can increase your contribution.
Okay. So can you actively contribute to a Roth IRA, and how many years can you go back if you can?
Yes. So yes and no. So it's always these fun answers with finance. It's always maybe, kind of. Okay. So you have until typically April of, like, for instance, 2021. You have until April to contribute to your 2020 amount. So they usually give you a little bit of leeway, but because of COVID, they've extended those deadlines and you are given a couple more months. Now, in 2021, you can't go back to 2019. It's usually just the year before. You can make contributions and, label it as a 2020 contribution, but it's just usually the year before. It's not any further than that.
Elizabeth, thank you so much for taking time out of your day to be part of today's webinar. For those in attendance, a recording of the webinar will be available on our website tomorrow. So once again, Elizabeth, thank you so much for being with us.
Thank you so much. And go Blazers.
Go Blazers. And don't miss out on upcoming virtual events. On May 20th, we'll take a look at the arts as a tool for healing and wellness with Elizabeth Vanderkamp and Kimberly Kirkland. During this webinar, we'll discover how the arts can enhance health during a hospital stay as we age and in community settings. And then on June 24th, I'll celebrate the success of this year's UAB Excellence in Business Top 25 Awards. The virtual award ceremony is free. And in the coming weeks, we'll also be releasing other virtual options for the summer month. Register or find out more at alumni.uab.edu/events. Are you looking for an alumni podcast? Check out UAB Green and Told. We're telling stories of members of the UAB community, faculty, staff, alumni. You can find the podcast on Spotify and the Apple Podcast app, or you can just visit alumni.uab.edu/greenandtold. Be sure to stay on top of all things alumni on social media. We are at UAB Alumni on Facebook, Instagram, and Twitter. For LinkedIn, you can search UAB Alumni Career Community. Finally, if you want more information about us at the National Alumni Society, visit us at alumni.uab.edu or just email alumni@uab.edu. Once again, thanks so much for joining us for today's discussion with Elizabeth Turnbull. Have a great afternoon, and as always, go Blazers.